red-hot rally may, in fact, have more room to run. Let's dig into the charts now with Jessica Inskip, Director of Product at Options Play. It's good to see you again. Why do you think it does have more room to run, as some are suggesting it's time to sell?
Yeah, it's really because Q1 is marking the highest level of negative guidance that we've had since Q3 of 2019. And all of those companies that gave us forward-looking guidance that was negative, the majority of that was actually technology, which means it supports that narrative of really setting the bar really low and then exceeding that. The negative implications from poor earnings has a precedent that's already been set due to that negative forward guidance that we've already received. From a technical perspective, which is really the important part there because of the rally that we've had in the Nasdaq 100, it is stuck between the January 30th high of 12,880 and the bottom of the gap that it formed in August of 13,175 to 13,210. So it's in this area that needs to gather momentum, and I think that momentum can absolutely come from better than anticipated earnings.
Wow, so it's not too stretched based on what the charts are saying, and you think that earnings will actually confirm the fact that tech can go higher rather than throw cold water on the move?
Certainly, and that's really because we've already received a lot of negative forward-looking guidance. So if we have received that, that sets the precedence that we certainly can overcome those levels. And then if you look at the broader S&P 500, Scott, every bear market rally has been fueled by an earnings season. So that narrative that we keep receiving consistently over and over is things are not as bad as they thought we were, I think will still follow through, at least for this quarter.
Yeah, that's early. We have to see. Google is on your mind today, specifically why?
Yeah, so when I look at the indicators that I do at this time, and note that these have not been of note until very recently, which is the 26, 40 and 200 weekly moving averages, because that gives me a quarter over quarter view and an indication of the trading cycle. So I pulled that across a lot of sectors, and the biggest cushion naturally is the Nasdaq 100 or technology, with about a 10% move, 9% based on today's movements. And Google really screened from someone that's at the bottom of that. So it has a breakout from the bottom of the trend. So I want to see consistent closes above the 26, 40 and 200 weekly moving averages. Google has done that 4 weeks in a row. So now we've got support at the 40 weekly moving average, which is 101. The next item that we need to overcome or milestone is 110. And in addition to that, from a technical perspective, Google or Alphabet has not really participated in the AI hype, and I really feel that that's largely due to a PR issue, not necessarily product. They have been investing in AI for 5 years. We've talked about it so much. Increased productivity is something that can help with the labor market imbalance in a way that can find equilibrium. And additionally, their CEO announced the movement from the Lambda model to the PaLM model as far as the back end of their AI capability, which really narrows the gap from Google's AI model to OpenAI's ChatGPT. Of course, like the backend requirements and data that it's trained on, it exceeds it. And so that is something that can spur once that's announced, in addition to their earnings coming up.